Hello, everyone, and welcome into crushthestreet.com. I am Kenneth Amaduri, and we're joined today with somebody who has given us a lot of insight in the past and pours a lot of research and time into learning about the cycles of gold, what's happening with precious metals, studies the markets. His name is Jordan Roy-Byrne of the Daily Gold, dailygold.com. And he's all over the internet. I mean, you can see him on investing.com, Kitco, Barron's, mining.com. And we'll have the link to his website in the description area. But we're going to be talking about where we are at now. If you look at what's been happening in the market with real estate, with commodities, with stocks, with crypto, everything seems to be booming. And in this everything bubble, obviously crypto being down to a certain degree, but we had this conversation, a month or so ago, we would be talking about Bitcoin at $50,000, $60,000, while gold is relatively, compared to everything else, at a bottom. Sure, it's at 1,900, but if you consider where it is compared to how much everything else has gone up, it's got a lot of room to play some catch up here, in my opinion. So we're going to get into that today. Jordan, thanks for coming on the show with me.
Hey, Kenneth, thanks so much for having me. It's a pleasure to be on with you.
Jordan, if you would, let's talk about $1,900 gold. How important is this threshold that we seem to be spending a lot of time at? Obviously, the 2011 high, and we've breached that briefly here, but we seem to be spending quite a bit of time here at 1,900. So let's talk about that.
Yes, well, yeah, 1900 it's actually weekly and monthly resistance. And at the end of the last month, we did in the last week, the end of May, or 2 weeks ago, I should say, we actually closed above it, but it was kind of a marginal close above it. You really need to see a significant close above a level by more than 1 or 2%. So closing at 1905 or 1907, not really that big of a deal. So yes, it is. I mean, I'm looking at on the daily chart, we have 1920, we have 1950, but on the monthly chart, 1900 is a significant level. This month is also the end of the quarter. I believe, I don't have the quarterly chart in front of me, but I believe 1900 on a quarterly basis is a significant level. So I think that's what we need to focus on would be, where are we closing the month? And as I said, the end of this month is the end of the quarter. But, bigger picture, I like where gold is at. And it doesn't, I think it's possible it could take more time to get through 1900 and make that next big leg higher because there is some resistance in this area. So it doesn't concern me if gold doesn't break out, in the next couple of months. I think, and as you alluded to at the very beginning, something I'm very keen on is watching the relationships. How is gold performing against bonds? How is gold performing against stocks? And one thing that's very interesting is if you look at gold against bonds, if you just look at gold against TLT, for example, that ratio has broken out and it's like at a 6 or 7 year high. And that's happened in recent months. So gold is now decoupling from bonds. So that's an important thing because if we see pressure on bond yields and interest rates, and if they start ticking up, in the past, that's been negative for gold. I mean, we've seen that in the last 10 months or so, but in the last couple of months, the fact that gold has broken out against bonds, that's a signal that moving forward in the future, if we do see higher rates, higher bond yields on the long end, that gold, that's not going to hurt gold the way it has in the past. So, and then we have, of course, gold against the stock market. If you look at gold against the S&P, I mean, that chart and also gold against the Dow. I mean, those ratios are, you have to look at a real long, I mean, most people, when they look at charts, they only look at 3 years or 5 years, look at a 10 or 20 year chart. And you can see that gold against the stock market, I mean, it's trading under this 7 and 8 year base. And so if and when gold, that ratio breaks that base, I mean, it's going to kickstart a major move in gold. Because what you're going to see is capital moving out of stocks and into gold in a significant way that we have not seen, since the early and mid 2000s. So that's a very important ratio for people to watch going forward. That's going to tell you a lot of what's going on as far as macro markets.
Mm. So, in your opinion, has gold and silver become a political thing? I know it's a random question, but I just know how the mainstream is, and if they decide to treat gold and silver as some sort of whack job, anti-government, anti-establishment sort of investment, which maybe it is to a certain degree, but if we start to see a real messaging against it, I mean, do you anticipate that to be anything that will hinder gold from being able to go higher?
No, I'm not worried about that in any way. I don't see that happening, at least not yet. And one thing I'll say is, I think Bitcoin and crypto maybe fit that bill as far as what you're asking about. I think
And that's why I asked
um,
it. That's why I did ask it, because I've seen what happened with Bitcoin. It started off as this libertarian, anti-government. This is the defeat the banking system, and it did start to bridge some gaps to a certain degree. Obviously, you have some of the biggest names in the world investing in it, but I mean, if it really started to become a threat to the financial system, I just have a hard time believing that the mainstream establishment's going to sit by and allow this to happen.
Yeah, the problem with Bitcoin and crypto is it's way too volatile, and it can't be a store of value when it has that kind of volatility. So I'm not, with respect to gold and silver, I'm not concerned about the potential political implications of a future massive bull market. I mean, sure, that's possible at some point, but if it gets to that point, it will be trading much, much higher. The juniors will, instead of juniors trading at 50 cents, 70 cents, 20 cents, they'll be trading at, $7, $10, $12, which you never see. Gold might be trading at $5,000 an ounce, silver at 100. So there's nothing to worry about if that comes to pass. We've already made a ton of money on it, and everybody in the sector will be independently wealthy. So I'm not worried about that at this point.
Yeah. Well, that's interesting. And it's an interesting point to consider. I mean, if gold does do what we all want it to do and what we're expecting silver to do, I mean, would it be fair to say that gold and silver are volatile as well?
But just not to the degree that we see in Bitcoin and crypto. I mean, if you look at the declines that Bitcoin has had going back to 2011, I mean, it's had multiple 70%, 80% decline. I mean, I can't think of gold, at least in a short period of time. I mean, other than 1980, but that didn't, gold. So it went vertical to about 880. Then it crashed, but then it had a rebound. So I think it settled out around 4. I'd have to look at the chart, but it settled out around, the mid 400s, maybe in the 80s. So it did 82. It did come down, I think, to 2 or below 300. But I mean, my point is good. Silver, even silver's had some crashes, but I mean, it hasn't had the crashes that Bitcoin has had. So yeah, there's a lot of volatility, but it's just not in the same category, in my opinion.
Yeah, no, I would agree with that. Obviously I think to a certain degree, crypto is just, it's new. So it's hard to make the same comparison, which a lot of people do, right? I mean, a lot of people are saying, hey, this is the new gold. Or like, wait a minute, hasn't been established by any means for it to be a competitor to gold or to be compared in the same way. But my only thing, and I alluded to it with my last question there, was, if we're going to see, and we're going to see silver move like we think it can. I mean, going to 100 is only like what, a triple and a little bit, maybe a quadruple, maybe. But I mean, going to 150, 200, that's starting to be, a crypto type move. Gold going to 5,000. I mean, that's only what, 2.5, which I think is very doable considering what we've seen with just stocks and real estate. I mean, but I definitely believe that the volatility of it may be a reason why it won't be money, or I would say endorsed by any government. It'll be wealth inherently, its character will be wealth storage, but it may not ever have any sort of endorsement by the governments, if you will, because of that same sort of reason. Plus, it's out of the hands of the government, right?
Right. Yeah. And I mean, I'm not a huge expert in all things crypto, but yeah, I would just circle back to my main point is it's too volatile to be money, and it's too it's not, you can't have that kind of volatility and be a store of value. I mean, if you think of people who are, super wealthy people who are independently wealthy, it's just my guess, but maybe they have 10 or 15% of their wealth in gold, and in crypto, maybe it's like 1 or 2%. So that's what I would say. Like, how do those types of people look at crypto versus gold? They're holding way more, gold and silver.
Right.
Compared to
Well, especially
crypto.
getting into it now, right? The part of the nuance is people that have been in it early started with 1 or 2% and seeing it become a lot more of a percentage of their portfolio, which begs the question on what they should be doing with their diversification. But that has been the case for a lot of people, is that they've bought crypto in the early stages, and if they held on to it, it's become a lot more than 1 or 2% of their portfolios. But yeah, let's talk about silver. I mean, silver, what an exciting opportunity to be in an asset that's a fraction of what it was in 1980. I mean, what other commodity can we say that is at this type of valuation nominally? Forget about the fact that we can adjust it for inflation. I mean, what are your thoughts with silver here? Does it take anything else? I mean, are we going to need to see more and more money printing for gold and silver to do what we all think can happen, or has what's been done in the past been enough?
I think what's been done already is enough, but technically the market just needs time. It needs more time. I mean, if you look at how things move historically, like if you go back to the 2000s and you look at the consolidations in silver, I mean, it had 2 or 3 bullish consolidations after making huge moves. And we're seeing the same thing now. I mean, it's doing a bullish consolidation. It's holding. I mean, it crashed and then it went all the way up to 30. And because I'm looking at the chart right now, and it's almost for a year, it's been consolidating. But if you look at those consolidations in the 2000s, I mean, they last, some of those lasted like a year and a half. So I've been too cautious on silver this year. I mean, I haven't been thinking it's going to break out. I still don't think I think it's too early for it to break out. I mean, I could be wrong about that, but look, if silver consolidated for another 6 to 9 months, it wouldn't be out of the ordinary with history. And that's what, people have to understand. You get too bullish. It takes a lot of time to set up these huge moves. Market just doesn't go straight to the sky. And especially with commodity markets, I mean, they need time to make those huge moves. And so silver, silver is really exciting because you have like in 20, 30 or 40 years, the cup and handle pattern in silver going back to 1980, that will be in textbooks. It will be like the godfather of all cup and handle technical patterns. And so if and when silver breaks above 50, I mean, it's really exciting because it could make a really explosive move. I mean, you have a measured upside target, I think of around 95 or 96, depending on how you calculate it. So that's what's really interesting about silver. I mean, it does have some resistance. There's monthly and quarterly resistance around 35 to 37. So if silver, breaks out of its consolidation, it's going to have, I think, a measured upside target of around 35, 36. So that to me is probably the next target. But if we're looking quarterly, like on a monthly and quarterly basis, 35, 37, those levels are pretty significant. So if we see like a quarterly close in silver at 38 or 39, that would signal that, okay, this is going to go to 50 and probably break it. And that, to me, that's what's exciting. But I'm also excited about gold because gold has its own cup and handle pattern. Okay, it doesn't go back to 1980 like silver, but it goes back to 2011. and gold breaking above, I want to say about 2070, or let's just say 2100. If gold breaks above that level and holds it, you have a measured upside target of around 2900, 3000 based on its own cup and handle pattern. So both metals have super bullish technical patterns, and where we are here and now, they're just they made a huge move last year. They're correcting, consolidating. They've held the gain, they've held most of those gains really well. That's what you want to see during a consolidation. And the answer is just time. It's going to require a little bit more time for the metals to consolidate. And that is going to give people, I don't know if it's another 6 months or another year or another 3 or 4 months, but people are going to have more time to accumulate these metals, also accumulate the stocks they want to accumulate. And I like to be conservative. I don't like to be a cheerleader, because almost everyone in the sector is a big cheerleader and they get too bullish. But honestly, these metals are setting up over the next 2 or 3 years. I mean, we could see some explosive moves to the upside.
Yeah. Well, and that's how I feel. I mean, when you consider how much money has been printed, I had in the instinct that, hey, we could see gold go to 5,000. I mean, many people talked about $10,000 gold in an environment where we didn't have this much money printing. I mean, this is not apples to apples. 2021 compared to 2018, compared to 2015. Obviously, we saw the trajectory that we were on. But I mean, inflation adjusted and money printing adjusted, M2 money supply adjusted, global money printing. I mean, we just have so much more upside, in my opinion, which makes the downside, if people are worried about losing money, I just don't see it at a major risk owning gold and silver at these prices. I mean, but you compare that to high growth or stocks or some of these other things that have gone parabolic. I mean, it's just, that's in my opinion where some of the downside is. But it's also hard to bet against the trend, and in whatever situation you're looking in. So maybe talk about that a little bit. I mean, talk about what we've seen with stocks. I mean, do you believe that there's going to be a inverse relationship to what's happening in the stock market to gold, or is there going to be some sort of flight to liquidity if we do see a big correction in stocks, which might break down gold and silver like we've seen last year and going back to 2008? We saw the same thing. What are your thoughts on this?
Well, I've done a lot of work on this, and from a long-term standpoint, the relationship is going to be inverse. So over the next 10 to 15 years, I think you're going to see the stock market, bond market really struggle. And I think precious metals, other hard assets, other markets like emerging markets are probably going to outperform. And there's a lot of similarity between the 1960s and 1970s to what we're seeing today. And again, like I say, I've done a lot of work on this. What was really interesting is the trigger in the 60s. You had a breakout in inflation in 1965, and then a real breakout in inflation. I want to say 1968, 1969. So that second breakout that we had, that 1968, 1969, that was the start of when hard assets were outperforming the stock market, and the stock market performed really poorly. Now, if you look at from the mid 60s or late 60s to 1982, the stock market had 3 or 4 declines of over 20%. So it was if you look at it, it was like a sideways trend for 15 plus years. And what happened is, over time, inflation kicked in. And so in real terms, you were really decimated being in stocks and bonds. And it's really interesting because if you look at a 60-40 portfolio, which is 60% stocks, 40% bonds, from 1966 to 1982, that portfolio did worse than it did during the Great Depression. And so the reason is because during the Great Depression, bonds went up. Like you still made money holding bonds, but that's why an inflationary period is so bad, because bonds lose money. They perform poorly, and stocks also don't do well. Yeah, they might keep their value in nominal terms, but when there's inflation, they're losing value in real terms. So if you look at a lot of these statistics, they're projecting And these are from Wall Street people, not gold bugs, but they're saying, oh, the stock market's going to do 2 or 3% a year over the next decade. But that's not even factoring in inflation. So if we have 4 or 5% inflation, you're losing money in stocks, you're going to lose money in bonds. And so the trigger for all of this, and we're getting really close to the point, the trigger is when, looking at the CPI, it's been trending down for about 30 years. But if we see the CPI, I mean, we've seen it, it's obviously broken out to the upside. And so now the question is, are we going to see the CPI hold above, 3%, 4%? If we see it stay in this range, over the next year or so, that's a signal that we have seen this like 30-year breakout in the rate of inflation. And now economic indicators are lagging. So it's easy to, look at history and say that was the key. But look, if the CPI and these inflation statistics, if they're not transitory and they hold this spike and they remain around these levels for a year or so, that's a signal that we could be in a new inflation regime. And again, go back to when this happened in the mid 60s and then the late 60s, right? That was the start of when stock markets and bond markets performed very poorly. So that's, I believe, what we're going to get into in the coming years. And so, I don't know how this particular economic cycle will end, but if you take the history from the late 60s and into the 70s, if we see, if we see rising inflation continue, and that's the problem for this expansion, eventually what will happen is we'll get to a level where the recession will kick in. And then during the recession, like we had in the early 70s, you could see stock markets sell off, and gold and silver do really well if it's an inflationary recession. Now, if it's not an inflationary recession, then the markets will probably decline together. But if we're just looking over the last year or so, you made the point, money has flowed everywhere except for precious metals, basically. I mean, if you're looking at the trend over the last 10 to 12 months, gold, silver, they've kind of been down to sideways. Bitcoin until recently has gone parabolic. Stock market's gone parabolic. Tech stocks have done really well. So the larger macro trend has seen capital, at least since last summer, capital's flowed out of precious metals and gone into other areas. And this is why watching the gold against the S&P 500 ratio is so significant and important, because when we see that start to move up, and if it breaks that 7 to 8 year resistance line, that's a signal that, okay, capital is now moving out of the stock market and it's moving into gold and precious metals. And so I think we're going to see that breakout sometime in the next year. And so all these things that we're talking about, we are at a point in history where we're really close to seeing a shift to where, inflation becomes the new regime, and where people are, average people in Wall Street, they're more focused on putting capital into these types of areas, instead of tech stocks and, conventional stocks.
Jordan Roy-Byrne, everyone. Jordan, that was incredible and great articulation, and so much of my bias, of course. I believe that we are going to see gold and silver go higher, but you connected the dots, on why we will see this happen, and I really appreciate that. If you would, just share some closing thoughts here, maybe something we didn't get to, if you want, or just if you want, let everyone know what they can expect to find when they visit you at the Daily Gold.
Oh, thank you. I have a lot of free articles there, free videos. You can opt in and get my book there at the top. You can subscribe to my YouTube channel, get on my free newsletter. So I put out a lot of free work. And I would just, if people, if they're new to the sector and they don't have a lot of info, I would just say educate yourself. Try and read everything that you can. Be skeptical of what you hear from people who have an agenda, but learn as much as you can, verify things on your own. Because I think over the coming years, I think this is, there's potential for life-changing gains in this sector. But you really have to educate yourself and learn, because in the 2000s, in the 1960s and 70s, precious metals did really well, but not everyone made money. Eventually you have to sell and take profits. You have to have common sense, and you have to also ride the trend. So it's tricky. I do think, holding gold and silver over time, they're going to move much, much higher. But, in the stocks, the juniors, which I focus on, there's over the next couple years, 2, 3, 4 years, I think there's a chance for life-changing gains.
Yeah, I totally agree with you. And a good reminder on not being delusional and taking those profits when it happens. And I think a lot of that will come down to, as your portfolios really get outsized with these gains, is reallocating that money. Maybe not selling everything, but reallocating money so you are properly balanced. But man, Jordan, thanks so much for your time. I look forward to speaking with you in short order here. I'm excited about what is to come here with gold and silver in this environment. So it was a great time to catch up.
Yeah, thanks so much for having me. I really appreciate the opportunity.